Right. Okay. So this is a pretty important topic, but it's more a conceptual idea, so that when you come to start preparing your income statements and balance sheet or your financial statements, you know exactly why you're doing what you're doing. Right. So let us take that equation now. Our full equation looks like this: D plus E plus A is equal to C plus L plus I. Right? This is our accounting equation. We have now arrived at this. What I want to look today at, or in this lecture, is to look at the concept of profit. What profit really is. I mean, for now, I said so far that profit must be I minus E. Okay, well, let's play with that. So let's start this business. 10,000 goes into the bank, 10,000. Then we have 50,000 borrowed here. We have 50,000 here. Okay, let's spend. I mean, it doesn't matter whether I buy on credit or I buy for cash. The point is, I'm going to have an E at the end. Let's just say I buy on credit. So I buy on credit goods worth 40,000. So I have 40,000 coming out. I'm sorry, not out of the bank. Well, I have 40,000 worth of goods that I have bought on credit. 40,000. And this, if you remember, we call the trade payable. Now, here's the thing. If I don't sell all those goods, imagine I only sold £20,000 worth of these goods, just £20,000 worth of these goods for 30,000. So, for example, I sell £20,000 worth of these goods for 30,000. So I sell for 30,000 and someone owes me 30,000. This is called a trade receivable. I mean, I might have received the money, as I say. This is really irrelevant. These two are irrelevant for now. This is what's important. So I purchased goods worth 40,000. I sold 20,000 worth, and I received 30,000 for those goods. Now, I mean, I guess you can see how it'll be a bit odd to directly compare. If I asked you, what was your profit? Well, it would be odd if you said 30,000 minus 40,000, because that would look as though you've made a loss. But you didn't make a loss. You sold £20,000 worth of goods in here. It's just that this is showing 40,000 right now for 30,000. So it only makes sense for us to, it only makes sense for us to compare like with like. So I'm going to say that again. Oops, I don't like that color. We need to compare like with like. That's really important. So how do we do this, right? Let me just get rid of that. Sorry. How do we compare like with like? Well, I need to compare the cost of 20,000 with the sale of 30,000, because that's what my profit is. The cost of 20,000 with the sale of 20,000. So what am I saying? What I'm saying is that I have some goods sitting in here that we haven't sold yet, and I'm not going to sell them today. So they will be in my stock room at least until tomorrow. So that 20,000 of goods that I'm not going to sell today is referred to as closing inventory. So I get rid of it from my expense and I put it under my assets. So they are an asset. I own those goods, at least for the night. I mean, they are asset because they will be with me. I will sell them the next morning, but at least for the night, they are assets. The next day, they will revert to being expenses again, but at least they are assets because we can't get rid of them overnight. So here we are. Now, what I have is an opportunity or a scenario where I can compare. I mean, because this net scenario is 20,000. So now I can compare this with this. So the process is to deduct what you haven't sold, which is referred to as closing inventory, from your purchases and store it as closing inventory. And this is important so that when you're seeing your financial statements, you understand the mechanics of what's actually going on. Right. So Now, if I asked you what my profit was, you will say to me, well, Owen, my profit must be, if I do this equation right, we will have, A is equal to C plus L plus I minus E minus D. And A right now is I have 60,000 in the bank. I have this inventory, these goods sitting in my warehouse of 20,000. I have this piece of paper saying I am owed 30,000, and this is equal to 10,000 that I owe, plus the 50,000 that I owe to the bank, and the 40,000 that I owe to the people I bought the goods from on credit. I haven't paid them yet, plus the 30,000 minus the 20,000. I mean, this 20,000 is made up of this 40,000 minus this 20,000. That's why I have 20,000. I don't have any drawings in this scenario. I mean, that's 0. You don't have to do anything. And you can see this equation balances. 60 plus 20 is 80, 110. 110 is equal to 10 plus 90, which is 100, plus 10, which is 30 minus 20. So my profits, I minus E, is equal to 10,000. So what is profit? Profit, if you like, is defined as what we have made on what we actually sold, not what we purchased. We purchased £40,000 worth of goods, but we only sold £20,000 worth of goods. And it must really be the markup or the extra, if you like, that we made on those £20,000 worth of goods, and we made a markup of 10,000, being able to sell 30,000. So this is a really important concept, and I'll extend this into the next video just to talk about what happened in the very next season. Okay, great stuff. See you in the next video.